Okay, this is probably the last lecture for today because I'm starving. I need to leave and go eat. But anyway, compute the break-even point for a multi-product company. Again, my hot dog example where I'm selling hot dogs, it would be unreasonable for me to assume the only thing I would sell are hot dogs. It's more likely the case that I would sell hot dogs, maybe some soda, alcohol if I could, chips or fries. But the idea that any particular company only sells one product is pretty insignificant. In reality, most companies sell a vast majority of products. And obviously, when we get into really sophisticated companies trying to determine the break even point for a company that sells hundreds of products, boy, that is difficult. In this lecture, we're just going to cover one additional product. So we're going to deal with a company that sells two unique products. And I think in the PowerPoint slides, it's not going to be soda and hot dogs. Better example, in my opinion. I think it's like footballs and softballs or some basketballs and footballs. Okay, so break even multi-product company. Some high level things that we need to keep track of. We are going to move away from the unit contribution margin, right? So we were saying previously, hey, we want to know the revenue minus the variable cost to get to contribution margin. And we were doing that for one particular product. We're now going to move away from that and we're going to do instead a weighted average contribution margin, right? So this could be product one, and then we'll have revenue, variable costs, contribution margin for product two. And what we're going to do is we're going to take the weighted average of products one and two, and we'll see what that looks like in the next example. Okay, so again, like I said, we're selling footballs and basketballs. So the sale price for footballs, $100. Sale price for basketballs, 120. The variable cost for footballs are 70, and therefore we're making a contribution margin of $30 per football that we sell. Alternatively, the variable cost for basketballs is 85, and we're therefore earning $35 for every basketball that we sell. Okay? So now, I'm not going to just take 30 plus 35 and divide by 2, right? 30 plus 35 divided by 2, that's what we call the simple average. It's just the average of the two specific products. We can't use that because a lot of customers will come into our store, and in this particular example, they're buying more footballs than basketballs. So the majority of customers come in, 6 out of every 10 customers is buying a football, whereas only 4 of every 10 customers is buying a basketball. So we need to account for that when we do our weights. And therefore, the formula for weighted average contribution margin, first, it's going to start with the contribution margin per product. So it would be $30 for the football. That's what we have here. And then 35 for the basketball. And then we're going to multiply those by the sales mix. And again, we said the sales mix for football, 60% of our customers buy footballs and 40% of our customers purchase basketballs. And therefore, the weighted average contribution margin for footballs and basketballs, given the 60-40 relationship, $32 per unit. So that's step one. Step one, when we have multiple products, we're going to first calculate weighted average contribution margin. Then once we have the weighted average contribution margin, then we can go to our normal or our previous formula, where we were saying, hey, listen, break even is clearly fixed costs, right? That will still be the numerator. And then we're going to divide by the weighted average contribution margin. So in our example, if our fixed costs are 48,000, and now from the previous slide, our weighted average contribution margin is 32, then we know we need to sell 1,500 units. Okay. That is step 2. Step 1, calculate weighted average. Step 2, determine how many units we need to sell. But now we're left with the question, if I know that I need to sell 1,500 total balls, right? How many of those are going to be footballs and how many of those are going to be basketballs? Well, I'm going to go back to this understanding that, to me, it's easier to do it this way. If I have to sell 1,500 units, I have footballs and I have basketballs. And I know that 60% of all my sales are footballs and 40% are basketball. So 60 times 1,500, I need to sell 900 footballs. And then 40 times 1,500, I need to sell 600 basketballs. They're doing the same thing down here. Okay. The number of units, 1,500, times the sales mix, or the percentage. And then if I sold 900 footballs and my contribution margin per football was $30, I would make $27,000 off the sale of footballs. Alternatively, 600 basketballs at 35 apiece gives me 21,000 in total contribution margin. 27,000 from footballs plus 21,000 from basketballs is a total of 48,000. And that is what we said our fixed costs were up here. And that is essentially this, or this is step 3. Actually, I should say that is step 3.